earnings fourth quarter call. I am joined here by the team, DCB team, which is here. I hope all of you have had a look at the press release, the two-page results, and the investor presentation that has been uploaded in the BSE NSE website. So we can straight away get into questions. Whoever has any question, please, we can start.
Sure, sir. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anuj Gupta from Perfect Research Fund. Please go ahead.
Good evening, sir. So, can you throw some light on the current revaluation of owned premises and the time frequency in which we consider to revalue the assets? I think lastly we have seen a revaluation in 2017 after 2009.
I don't think we report those numbers, and I'm not even sure how critical it is to our today's discussion. So I suggest that you contact Bharat offline and take those numbers.
Sir, I tried to contact it offline, but I was told that everything is given in the annual reports, and as per that only the disclosure is done.
So those are our disclosures. So, that is what you have to go by. We don't disclose anything more than that.
Okay, sir.
Thank you. The next question is from the line of Darpan Shah from HDFC Securities. Please go ahead.
Hi, sir. Thanks for giving the opportunity.
Yeah.
So, around 2.5 years back, we had given a guidance of, Q4 FY19 exit of 1% ROA, which you have achieved. So what next for us? How do you see things shaping out there for us?
So the way we are looking at the future is that retail, AIB, that is Agri Inclusive Banking, commercial vehicle, gold loan, SME, MSME, the products that we do, which is small ticket, secured, largely secured portfolio, except the MFI loans that we do and a very little personal loan we do. We continue that. There is no change in that strategy. We believe that we should be able to double the book in 3.5 years or so, and which is what we have been doing. If you look at our this year's number also, if you exclude corporate loans, which is only 13% of our book, we have grown our loan book other than that at 21%. So if we continue to do that, we believe that we should be able to double the book between 3 to 4 years. We will focus on continuously trying to reduce the cost-income ratio. A lot of the people felt that we don't have any scope in reducing cost-income ratio. We will not be able to achieve. In fact, look at our exit cost to average assets. It is 2.4. So, which probably was about 3% for 3 quarters or 4 quarters. I'm not very sure when it was, but it was not too far in the past. We will continue to maintain good quality assets, barring any unforeseen situation. We think that our asset quality should hold. We have provided almost the same amount of credit loss as we had last year, and we've had a very good coverage. Our underlying coverage ratio is about 65-66%, and the overall coverage ratio is almost close to 80%, which means that we are providing well for the assets. And mind you, those assets are secured assets. We've also had phenomenal success in terms of getting back money from ARC for the SR. In the last quarter itself, a lot of money came back from the almost 10 crores, Bharat is telling me. So maintain good quality assets so that your credit cost remains in the range that we have indicated. Keep improving operating efficiency. Keep improving utilization of capital. Look at our risk-weighted assets and look at our capital adequacy. In fact, our capital adequacy is higher than what it was at the start of the year, and you can look at the risk-weighted assets. Our consumption has been a lot of efficiencies have come in the consumption of capital. So I believe that in the future, as we move forward, step by step, all these metrics should increase. We have some desire to take it even higher to like a 16% ROE, 16.5% ROE over a period of time.
And so that should translate into an ROE of say 1.3, 1.4 over the next 3 years? Or
I can see about 1.25, 1.3 for sure at the moment. But as things unfold, one of the jobs that we have to do much better than what we do today is on fee income. Unlike corporate book where you get a lot of fees, here it's all very granular fees that requires a lot of hard work. We are doing that. We are finding success on that as well. But having said that, a lot more work is to be done.
Okay. And so just, you mentioned, ex-corporate, the book growth is 21%. So, what has happened in corporate this quarter? It has fallen sharply. So, any lumpy repayment?
We are moving more and more in corporate towards short tenor, less, less capital consuming kind of products, which are more to manage liquidity. We are being very selective in giving loans which are longer tenor, or even for that matter, the CCODs in multi-banking or in consortium kind of thing, because we believe that given our cost of funds and the kind of pricing that is demanded by the market, doesn't seem to actually help us in ROE. But if you do short tenor loans, it seems to help us in our liquidity management, and it is also good in our earnings. So that is how we are kind of reshaping the whole book. So, and therefore that is why it falls. And sometime maybe in the mid quarter it may be higher than the end of the quarter, but that is how the book was moving the whole of this year.
And so one last question, if you can just throw your inputs on the mortgage book in terms of growth, competition, pricing, etc.
See, we are focusing on, we have introduced, I think we have mentioned before, we have introduced a concept of ROE calculator. We are not blindly chasing volumes. There is a lot of volumes available. To just digress a bit, I have seen even recently, like 1 week ago, a loan from our book being taken over by one NBFC at 100 basis point lower and double the exposure. And I can't see any sense in trying to retain that loan at a liquidity risk and capital risk and no ROE or lower ROE. So I don't see it. So I think the opportunities for growth is plenty. But if you have to draw a risk appetite bracket and a ROE bracket, then that is exactly what we are chasing, which I think is allowing us to grow at about 18-20% in mortgages. Competition is still very tough. I would say from all NBFCs, but a few. And then some banks, of course, are offering a lot of competition. But I don't see any issue with the portfolio quality. Portfolio quality has been more or less stable. If you look at our gross NPA slippage and recoveries in the last quarter, we had about 100 crores of increase in NPA and about 82 crores of recoveries. We always struggle on recoveries in corporate NPA. We don't seem to have much struggle in terms of recurring SME and mortgage NPAs.
Okay, thanks a lot and all the best.
Yeah, thanks.
Thank you. The next question is from the line of Amaya Satya from Tata Mutual Fund. Please go ahead.
Hello.
Yes, Amaya.
Yeah, so one question on the margin side. So we keep comparing ourselves to say City Union Bank as a benchmark. So if you look at their margin profile, they're at 4.3, and we are around 40 basis point lower. So
their NPAs are 2.7 or something, closer to 3. Our NPAs are below 2. So mention that also.
Yeah, and then so my question was that, so are there any factors that we need to work on so that probably we can bridge some of the gap? And if that's possible, how much time it can take in your view?
I think one of the things that we have to work on, definitely, and that is what we are working on, which will also help our LCR more than today, would be on making our retail term deposits even more granular than what we have. On the loan side, for example, we have only 5% to top 20 exposure, or maybe 6% to top 20 exposure. Whereas in the deposit side, we are probably at about 12% in top 20 exposure. So our intention is to bring that down to about 4-5% over a period of time. That is a work in progress for us. We have compared our deposit profile with City Union Bank, and we think there are a lot of lessons to be learned in terms of how they manage their deposit profile versus how we are doing it, which we have put into action. We achieved our LCR yet again. We crossed 100%, which was a problem in some ways in the last quarter, which ended at 80, and this quarter we have ended at 105%. Average is still about 90, which we hope to address in the coming quarter. So focusing more on retail term deposit, shifting the goal, shifting the scorecard of the branches to focus on more retail deposits, granular deposits, is clearly something that we are learning from them, and that definitely will help us to have better cost of funds rather than some of these, I won't say volatile, but some of these low deposits that we have from cooperative banks and all tend to be price sensitive.
Okay. I think that helps. And second question on the asset quality side, do you see any issues coming into the next year? Anything that bothers you?
Usually, I don't lose any sleep over mortgage, SME. Commercial vehicles showed some here and there uptick in NPAs, but didn't really bother us that much because we were confident of the recoveries of that. Usually, we get worried about any 2 or 3 corporate loans. Even I think this quarter we have had one corporate loan that has slipped to NPA, but the NCLT process seems to indicate that we should be able to recover it in the next 2 quarters. So other than that, at the moment, I don't have any concerns.
Okay. Great. Thanks a lot and best of luck for the next year.
Yeah.
Thank you. The next question is from the line of Dhavalkara from TST Mutual Fund. Please go ahead.
Hi sir, congratulations on good set of numbers. Just 3 questions. First is on, sir, what should be the normalized cost to assets ratio for our sort of business model, say on a 50,000 crore book size, what should be the more normalized?
ऐसे कुछ normalized वगैरह कुछ है नहीं. My dream is at some point we should be at 1.75. I mean, that is all we are thinking about it.
And how far
believe it, but that is our dream. But can I achieve it, or will we be the team achieve it like tomorrow, next year, something? Maybe not. But I personally believe that it is possible. If we can come from 300 basis points to 40 basis points, then why would we not able to bring down to 200 basis points? So I don't think there is any ideal number we are pursuing. We think that there is opportunity for improving staff productivity. I think we are already at, I think I told you guys that we are looking at 10, 11 crores of business per employee. I think we probably are almost close to 8 now. We were not too far ago at about 6.8 or 6.5 kind of thing. So I think it is possible to further achieve, but there is no ideal number that we have in mind.
Understood. The second part was on credit cost. So what we've seen in FY19, in your view, is it running below the sort of model levels which you sort of expected at the start of the year or when you priced the loan, or are we like broadly in line with those levels? Like I'm just trying to understand, what kind of benefits are we seeing on the credit cost in this part of the cycle?
So I hope the work that we are doing continues to give us benefit. We definitely did increase headcount in our collections. As you know, we have all collections in-house. We don't outsource any collections. We have more than 500 people in collections. Of course, if you had to pick up a truck or repose a truck, that would be outsourced. But other than that, the entire customer contact, collections, recoveries is all done in-house. We have been mentioning to you in previous calls that mortgage business or any installment loan business and all, once it becomes NPA, the pipeline takes time, but once that starts to pick up, then more or less the slippages starts to match up with the recoveries. So we hope that our recovery trend continues. This year recoveries have been pretty strong, especially in the 4th quarter also we did very well. And we have done decent provision coverage. We are at about 65, 66 underlying provision coverage. That also includes the floating provision that we continue to make, irrespective of the profit or income or whatever. We continue to make floating provision, which is part of our net NPA calculation. So I don't think there is any change if it's just going on as usual.
Sure. And just so lastly, on pricing environment, I mean, your thoughts, was now versus maybe 6 months back when we sort of started with the NBFC issue. I mean, how is the pricing environment behaved?
No, better. If you see our 4th quarter pricing has got a little bit of uptick.
Yeah.
But I think the price, I'm not saying it's all disappeared completely, but it is not as bad as it was in July of last year. Okay. But we have chosen to change the profile of our funding. We have taken a lot more refinance from SIDBI, NABARD this year, because we do have longer term assets like mortgages, so we need to support that with more longer term refinance. Over time, we will rely more on longer term deposits, which is like 2-year, 3-year type of deposits. I believe that maybe 1st quarter may have a little bit of issue on NIMs, or maybe even 2nd quarter, but overall stable NIMs, we are looking at 370, 375 basis points.
Right. And just two data keeping question for Bharat. One, what is the employee count at the end of the
6,100 something, yeah. 6,134.
Okay.
6,134.
And so second is on slide 9, we have this breakdown of other income. The balancing figure is sizable. So if you could just say what is the single largest item in that, that would be very useful.
Page number 9. Yeah.
On a full year basis, we have earned 28 crores on sale of PSLC.
Okay.
A lot of it has come in Q4, sorry.
See, the way PSLC works is that first it is recognized in like the fourth quarter will get the entire recognition, and then it goes back to a lower number again as we start building that fee income.
Correct. Perfect. Sir, great, sir. Thanks. All the best.
Yeah, thanks.
Thank you. The next question is from the line of Jehan Bhatter from Nirmal Bang Securities. Please go ahead.
Good evening. Sir, I have two questions.
Yeah.
First, the fee income has been subdued in last 2 quarters, which you also mentioned in your opening remarks. So YOY it has grown at around 5%. So going forward, what can be the trajectory for next year? And the second question is whether you will need to raise capital over next couple of years, or the existing structure will suffice us, to not raise capital.
The amount of work that we have done on efficiency and utilization of risk-weighted assets, and then obviously capital, I don't think we need capital for at least 6 to 9 months, and we'll see how the trajectory goes this year. So we are quite a lot of effort that we put in from last year's fourth quarter onwards is starting to show some decent result for us. So I don't see us needing capital at least for 9 months, which would mean that we probably would be moving to next year on this, right? Regarding your fee income, core fee income is doing well. We are seeing very good traction in our third-party distribution fee income. Year on year, we are seeing improvement in that fee income in line with our expectation. We probably need to do a lot more better in trade fee income. We are seeing pretty decent traction on foreign exchange, merchant income. ATM fees have been a little up and down because there's a lot of flux in terms of upgrades of ATM that we need to do to meet the regulatory requirements, and that has caused some level of disruption in terms of ATM fee income. Rest of it is all like, if you look at our PSLC income, it is better than last year, and fourth quarter has been phenomenal in terms of PSLC income. So I think that 14-16% growth in core fee income seems like a very good possibility for us.
Okay. Thank you, sir.
Thank you. The next question is from the line of Ravi Singh from HSBC. Please go ahead.
Yeah, thanks for the opportunity. If I haven't missed it, what are we saying about branch expansion from this year onward? And related to that, clearly very good work on the retail deposits, retail TD growing at 30%. So even if, for example, branch expansion is slower than what we have done in recent years, is it likely to sustain? Because I would expect a large number of branches will be maturing over 12 to 24 months. And what sort of break-even or productivity improvement you are seeing on the branches which you opened during those 2 years of accelerated expansion?
See, the cost-income ratio improvement is a reflection of the holding cost steady and getting more out of the branches. So obviously, the branch expansion plans are playing out. I wish all the branches that we put work exactly like the way we want, but I shouldn't complain because there are branches which are doing phenomenally better than what we expected them to do. We believe that a lot of our branches still have capacity, 2 types of capacity. One, we can put more people in that because we see a business opportunity. And 2, the existing people that we have put also can produce more. We have to again refine our scorecard and so on. So I don't see any issue. Branch expansion, we believe that 15-20, which is what we have been guiding, is what we have in mind. Once we get much better profitability numbers, ROE and all, we will evaluate whether we need to expand faster. At the moment, we are looking at 15-20 branches.
Okay. And while you mentioned the impact of demonetization in GST in these last 2-3 years, I'll assume this was more on the growth rather than any asset quality or margins related impact.
Definitely. Please look at our transcripts of December 2016 and all. I remember taking 33 crores additional NPA because of demonetization.
Yeah.
There has been positive and negative impact of demonetization. I can't say everything is negative. I can't say everything was positive.
So broadly, are you seeing things normalizing the segment which you cater to? Is it coming back after taking impact of GST and demonetization in terms of credit demand and their cash flow performance, etc.?
GST, I think more or less, I think I mentioned even in the previous call, we are seeing definitely that seems to be those kind of issues seems to be behind in terms of SMEs who are dealing with that. Those who had to kind of collapse, I think they are finished. Demonetization, even this current quarter, one or two customers we had struggled and their business models got affected during demonetization. Even 2 years after that, they are not able to fully recover from there. So hard to say, but I would say that situation is more or less normal.
Okay, thanks for coming.
Situation can never be normal also, I'll tell you, because SME ke liye, there may be economic reason, demonetization, GST has some reason, but they themselves also create a lot of reasons for us to worry about. For example, they will go and make some stupid investment, they will have some family dispute, they will suddenly discontinue a product without even understanding what, or they will go and invest in. So they themselves create a lot of problems for the bank as well as their own business. So those are things that bother us more than GST demonetization, at least as of now.
Got it. Thank you.
Okay.
Thank you. The next question is from the line of Hardik Jain from Whitestone Financial Advisors. Please go ahead.
Sir, firstly on a cost side, so you mentioned that incrementally we'll be doing 10, 15 to 20 branches.
Yes.
So operating expenses should grow at what, 8 to 10%, or you think it can grow a bit more also?
ऐसे हम specific cost guidance नहीं देते हैं.
Yeah.
So
but it will be more or less in line with the inflation. I mean,
it depends. I mean, there's a lot of work that we do which kind of, even though there may be increase of expenses because of inflation, because of productivity, that cost may actually come down. Process changes sometimes help remove cost that gets added. So generally, our idea is that step by step reduce the cost income ratio.
Okay. And secondly, sir, you mentioned 28 crore PSLC income. This is for the full year. So how much would be Q4 in Q4?
Q4, do you have the number? We don't have the details yet. We have it? 13 crores. Yeah.
13. Okay. And lastly, you mentioned...
that last year also would have had last year was 10, this year is 13.
Okay. And you mentioned we recovered some 10 crore from ARC. So that also included in other income in Q4?
No. That is the SRs that have come back. Bharat can explain.
If you see the presentation where we have given on page 13 the NPA numbers, these are line below. The point we are trying to make is total of 74 odd crores of security receipts were issued to us against sale of NPAs to asset reconstruction companies. These assets, underlying collateral is being progressively realized by asset reconstruction company, and they are redeeming the security receipts in hard cash. So we have received back money, and now it's down to 38 crores left over out of 74 odd crores we started with. In last quarter alone, 10 crores was released, and if I'm not mistaken, over the last year, approximately 25 crores have got released. As compared, if you see the security receipts against sale of corporate NPAs, very few banks have realized anything. They have started providing for it.
Okay, but that does not come into the PNL, right?
No, it does not. Not at all.
Okay.
It's an asset that is not earning us anything, but when 10 crore comes back, that means that much more benefit we'll get.
25 crores which got released in last year, I would be able to deploy that fund because the drag on my earlier I had to fund it. So that I'll be able to deploy alternately, and also it releases the capital which is long.
25 crore agar release ho gaya in SR, that means it's equal to one branch CASA, right? Yeah.
like that.
Okay. And sir, just last one question. So during after the demonetization in GST, in some of the call you mentioned that when you meet the clients, they are started to disclose higher income, and thereby requiring the higher limit, working capital limit. So do you see that thing continuing, or you feel that that was just during the start of the GST, and now even now the
I got your question. I feel it is continuing. I definitely see that in our SME, MSME business where we give working capital loans. I hope it continues, but at least for the last 1 year or so, we have seen, or at least last 2 to 3 quarters, we definitely have seen improvement in throughput.
Okay, thank you.
Yeah.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good afternoon, sir. Just a couple of questions. One to Bharat. The question on where is these RWA gains coming from in the portfolio, and if you could give some color on the provisions. Question to Mr. Murali. Just wanted to check. Have you ever thought of looking at products which is in the higher yielding segment, north of 20%, apart from MFIs, especially on the SME side? And also, if you could just give a qualitative comment as to are you comfortable with the productivity levels that you're seeing of your employees? Thanks.
Productivity levels are improving, but we don't have any ideal number or any happy number there. The way it works is, if you are familiar with branch banking, the way it works is that you just have to keep pushing the envelope on productivity. For that, what you have to also do is you have to take away some of the non-value adding work, because they will complain saying that they don't have time to do more volume. Then you have to say, where are you utilizing your time? Show me. And then we at the back end have to figure out how to improve the process. So it's a continuous battle in terms of how you improve productivity, not just in frontline, but definitely the frontline thing. And that is managed to scorecard, that is managed through process improvement, that is managed through product mix. It's like a whole process that keeps happening there. I think that we should be targeting at least 11 crore business per employee. We are close to 8. We keep presenting that to our employees to tell them as to how we can do more, other banks are doing better, etc. Of course, you have to take into account that our corporate loan book is very light. That can help improve business per employee, but that is not the way we want to get it done. That is point number 1. Point number 2, you asked me about risk-weighted assets. Okay, so how the improvements are coming, I'll tell you. We have several products ranging from requiring capital at 35% to 50% to 75% to 100%. Okay, now the ROE calculator that we have given to the business manager, he can put all these parameters and he can clearly see for each loan what is the kind of risk-weighted asset he is consuming and what is the price he is charging and whether it is making sense from a ROE or not. So that changes the behavior and they focus towards less risk-weighted asset consuming loans which give them better return. For example, in SME, I can do a loan which is 100% risk-weighted asset, or I can do a loan which is 75% risk-weighted asset in terms of the segment. So they choose to do the one that is consuming less. Second thing is, we examined our portfolio and we looked at which are the customers who are consuming 100% risk weight and are not giving us the return that we desire. So we went back to them to to see whether they would be open to repricing so that we get the ROE. Of course, we have to make sure that MCLR and all that is respected. Or they take away the loan to some other bank who can afford to take that loan because of their cost of fund being better. This is how we have brought about, and in of course corporate it's very simple. Rated the companies give you better risk-weighted asset than others. So that is how we have done the. There is no magic sauce in this. It's just the same loan by loan focusing on risk-weighted asset.
Thanks. Murali, just a question on the high-yielding portfolio, which some of the banks have now started to concentrate.
Good. I think we are not ready yet to expand into that. I think there is a lot of work that we can still do on fee income and improving the productivity of the branches. So at the moment, the management team's view is not to introduce any such product. I think there's opportunity for us to do slightly better yielding loans in mortgage itself, which we could do. Other than that, right now there is no other plan.
Sure. And
loans, by the way, we do personal loans at 17-18%, but a very small, tiny portfolio.
Okay. Bharat, the provisions breakup?
Yeah, what about provisions?
The 348 million that you have, what is it? Is it fully for loan loss provisions or is there any?
The loan loss provision, and this is not, as we have explained in past, we do more than what is RBI baseline.
Yeah.
Okay, that's why we are at 65% coverage. Loan loss provision is approximately 26 crores. Floating and standard assets is around 7, and 1 odd crore rounding off is on investments.
Okay, perfect. Thanks a lot.
Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Sir, is 2020 target you have achieved and you are very near today, any further planning would you like to share?
So over time, we want to cross 16%, and inshallah, over time we'll try to cross even 18. The way we will cross that would be improve fees, improve cost efficiency, and loan growth. So there is nothing very different from what we are going to do, what we have done in the past. We are pretty confident that we can continue to improve our cost income ratio. May not happen linearly. Sometimes it is easier to put it on a spreadsheet and think that it can happen, but that's not the way. Like for example, first quarter, our cost will hit us because of staff cost increase. Revenues won't kick in. First quarter does not have PSLC benefit. So, it will be up and down there, but generally, directionally, we are very confident that in 2 years' time or maybe 2.5 years' time, we should be able to cross 15.5, 16% ROE, and then consequently the ROE. So that is the plan. So let's see how we go on that. At the moment, we are quite happy that at least we have come very close to what we have committed in our branch expansion.
Right. And what is the cost income ratio is in your mind after 2 years and 3 years? Can you tell something?
I did mention, instead of mentioning cost income ratio, I said, I think we should aim for below 2% cost to average asset. But it will take time, but we think that it is possible. Our business model, it is possible, we think.
Okay. Thank you. All the best.
Yeah, thanks.
Thank you. The next question is from the line of Renish Bua from ICICI Securities. Please go ahead.
Yeah, hi sir. Good evening. Congrats on a very good set of numbers. Sir, just one question on the loan growth. So the exit loan growth for this year is actually lowest in last 8 years. See some of this part might be explained by the corporate book unwinding. But would it be because of this new ROE metric what you have introduced at the branch level, that some of the volume might be your branch managers might be letting it go to some other banks to meet this ROE metric?
100% possible. 100% possible because we want to make sure that the liquidity, capital, and credit risk we take helps us to deliver good returns. No point in just blindly pursuing any volume. So it definitely is possible. But I would say that when we introduced this calculator at the beginning, we probably were refusing a lot more loans. But the sales team starts to orient itself in the origination itself to a good set of loans that will actually achieve the ROE. So that whole process does take time to fall in place.
Right. So basically, so it's a follow-up question on that only. So This exit loan growth of 16%, is there a scope for a further improvement as we move ahead with the lower base on the corporate portfolio, or do you see the same unwinding rate which we have seen in Q4 will be continuing Q20 also? So what is your
corporate loan? I will not comment because we don't. We see that as a short tenor, opportunistic kind of the thing. We don't. The team that was there with us several years ago is the same capacity that we are operating in corporate. Other than corporate, we have grown by about 21%, and we are confident that that kind of growth rate is possible with our capacity.
Okay, yeah. So that's very helpful, sir. And sir, secondly, on the margin side, in your opening remarks, you have mentioned that we will be sustainable around 3.7 or something, which will be like 8-10 basis point lower than the exit Q4 margin. So sir, what will drive this moderation? I mean, do you see the asset yields are under pressure because of the competition, or do you see as we move ahead to to achieve a granular retail deposit, we might have to offer higher rates? I mean, what will drive this moderation in margin side?
The MCLR implementation is such that when you change the deposit rate, immediately the MCLR changes.
Right.
So, for example, let us say I change the MCLR rate, the deposit rate for a 1-year deposit. The MCLR has to be dropped immediately without the new deposits coming in the lower rate. That's the way MCLR formula operates.
Right.
Whereas in a rising market, supposing I increase the interest rate of 1-year deposit, MCLR can be reflected immediately. Right? So, as we reduce the deposit rate in line with the market, we think that there will be some impact on MCLR and then therefore some impact on NIM for a while before it stabilizes. That is point number 1. Point number 2 is that we are very clear that we want to achieve similar to what we have been able to do on the loan side in terms of granularity in the retail deposit side. So your point is right. We may have to look at some buckets, looking at maybe 10-15 basis point higher to kind of change the branch behavior as an example. Right?
Right. Absolutely.
So the transition will take a little time, but we are confident that stable NIMs could be at 370-375 basis points. We have modeled that.
Right. So, I mean, just, a further clarification on that only. So, as we try to implement this on an aggressive basis, let's say next 6 to 8 months, it is right to assume that our margin will not be impacted more than 8-10 basis points, right?
Yeah, I don't think so. I don't think so. They have also done a lot of, we are quite happy that we were able to, because of our good quality portfolio, we were able to attract refinance at a reasonably rate, although the rate is higher than the deposit rate, but it is long-term money and therefore it helps LCR, it helps the various buckets, liquidity buckets. So that also we have taken quite a lot in this current financial year.
Right. Right, sir. And sir, lastly, if I may ask, moderator.
Yes, go ahead.
Yeah. So, sir, broadly, as your long-term plan is to reach ROA of 1.25 or 1.3, sir, what is the driver for this improvement from the exit level, let's say from 1% ROA? If you just can break it up into a couple of levers, that would be really helpful.
Definitely, cost would be a lever.
Right.
And we expect that our fee income would also be another lever that has not been fully exploited. And we hope that the way we are doing product mix, that we have not too much of sacrifice in margin, at least only near-term sacrifice at all. And we definitely think that if we maintain our quality of portfolio, then we should not have any surprises in our credit cost. So every line will be contributing some improvement, some the benefit. Of course, the overall business per employee is where we are focused on as to how that productivity can drive better results for us.
So broadly, the productivity improvement will be the biggest driver.
ऐसा नहीं है, मतलब हर एक लाइन में काम चल रहा है. So therefore I can't say, even I'm telling you, when we talk about efficiency, we look at capital efficiency, we look at people efficiency, we look at so everything, collection efficiency. So there's a lot. I can't say there is any one magic button that we have.
Right. Okay, sir. Got it, sir. Thank you so much, sir, for the clarification. Thank you, sir.
Thank you. The next question is from the line of Ashish Sharma from Inam Asset Management. Please go ahead.
Yeah, thanks. I think most of my questions have already been answered. Just wanted to clarify on the capital raise part. As you mentioned, so we would not be raising capital for next 6 to 9 months. That's what I think you have indicated.
At least for 6 to 9 months, because Abhi, with the 16.81 capital and what plans we have, and if we continue to drive efficiency in capital consumption, I don't see the need to raise capital.
Okay, sir. And just on the growth part, so the Q4 and quarter number, the year-end number of 16%, this is because we want to defocus from the corporate piece.
Yes.
But going forward, the run rate in terms of growth has to be. I mean, we have always been guiding that 20 to 25% is the range.
Guide like that. We have always said that we are aiming to double our balance sheet in 3.5 years, which whatever that it translates to is what we are aiming for.
Okay. We stick to that sort of.
We are absolutely working towards that.
Perfect. That will be all the best for the next quarter, sir. Thank you.
Thank you. The next question is from the line of Abhishek Modi from Asit C. Mehta. Please go ahead.
Hello.
Yes.
Thank you, sir. So one question with regard to MCLR. Now, the RBI already cut by 25 basis points, it's 15 now. So when, according to you, a bit color, but not exactly the time, that you will be able to transmit the rates, means by June, July, any just idea?
No. The MCLR is the calculation of each bank on its own.
Yes.
Based upon their deposit profile and their this thing. At times, it may have a direct, this thing with RBI. And that is a discussion that has been happening, I guess, for the last few months with RBI in terms of their external benchmark and all.
Yes.
The way our MCLR is very simple. You have a cost of funds, which is how to calculate that is given by the regulator. The cost of, banking is, I know a lot of press starts talking about bank is not passing on and so on. I can tell you that MCLR calculation has the cost to average assets as an important item. So if a bank reduces its cost to average assets, it gets passed on to the customer. That is how minute the calculations are in MCLR, and that is all audited by both statutory auditors and the Reserve Bank RBS team. So I can't tell you exactly when it will happen. Depends upon how our MCLR moves. At the moment, there doesn't seem to be any scope to pass on, but I don't know how the first quarter will come through. This is being reviewed every month in our ALCO meeting.
Fine, sir. Thanks. And one more thing with regard to slippage. I think it is 985 million, if I'm right. Just want a general idea. Is it how much is it? Any idea? Agriculture 20.
No. It's across, and it is there in our. You can see in our page 13.
Page 13.
Page 13, you can see our gross NPA. Sorry, this is all the gross NPA, right? Yeah, gross NPA.
I just want a slippage. Slippage is 985 million. The breakup is not. I just want a general idea.
No, we don't provide the breakup. What you have is the page 13 where you can see generally what the movements are.
Yeah. So just one more thing. Any idea with? Are you seeing any pressure in agri sector, SME sector? Any just idea with respect to that?
Agri sector was under some pressure when we had all these waiver issues and all, but I think the team was in a little bit of a panic mode immediately when it happened, but later on I think we've got reasonably good control over the portfolio. So while we are having here and there some pressure, but overall we are still in control.
And SME, sir?
SME ठीक है, जैसे चल रहा है वैसे ही है. There's no big
okay.
Ticket always causes challenge. Any loan which is a 3, 5, 7 crore kind of loans, they always cause challenge. Small ticket fellows are quite manageable.
Okay. Thanks, sir. Thanks so much.
We have time for one more question.
Sure, sir. So we can take last two questions. The first would be from the line of Ankit Chaudhary from BNK Securities.
Hello.
Yeah, go ahead.
Hello.
Yes, go ahead, please.
Yeah, hi. So I'm not pretty sure that this question has been answered or not, but basically the corporate loan that has declined on a quarter-on-quarter basis. So was there any loans that we sold off during the quarter?
No. Fortunately, the loan got paid off during the quarter, so that is why it has come down. It is a part of our strategy of giving short tenor loans, and sometimes it gets paid off the quarter. It so happens that many of these loans got paid off before March quarter.
Okay, understood. Second thing was on this NIM part. So that you have explained 2 questions back only that whatever the increase that has been taken or decrease you take on the deposit that gets passed on the MCLR. So as we see your cost of fund and both these things have moved in the same direction.
Yes.
So also wanted to understand a bit thing that apart from this thing, has there been any changes in the product mix or something of that sort which has, or you've taken a price increase or something of that sort which has led to your yield increase?
Product mix is changing, no? Because if I am dropping corporate loans from say 15 or 16% to 13%, that means we are getting more traction. I think AIB has moved from 18 to 20%. I think SME has probably remained at 12 and mortgage is at 40. So construction finance, commercial vehicle has gone up a little bit to 7%. So product mix is changing, steadily it is changing.
Okay. And finally, on this GNPA on the commercial vehicle and construction equipment, so that increase, so has it been more of a slippages or the less recoveries that has played the part over there?
So we don't do construction equipment. We only do commercial vehicle.
Mm-hmm.
So it is commercial vehicle and small ticket vehicle or some, what is it called? And we don't do that much, but just that the product description in the system is CVS, CVL, whatever. So we don't do construction equipment. The slippage is there because we did see some challenges, market challenges in commercial vehicles, but recoveries are picking up. So I do believe that in the coming 2 or 3 quarters, we should have a much better performance in commercial vehicle NPAs.
Right. Okay. Thank you so much.
Yeah.
Thank you. So we'll take the last question from the line of Pranav Gupta from Birla Sun Life Insurance. Please go ahead.
Hello.
Hello, yes, please go ahead.
Yes, thank you. My question has been answered.
Great. Thanks a lot, everyone, for joining the call, and thank you for your support. We will keep in touch. If in case somebody's question is not answered, please feel free to reach out to Gaurav or Bharat, and then we hope that we can address your questions. Thanks very much for joining this call.
Thank you very much. Ladies and gentlemen, on behalf